First, there was the high return real estate show, now upgraded to the higher return real estate show. Deeper insights, greater value. It's time to build your empire.
I'm sure that most of you listening are probably saying the same effing thing. I'm not where I want to be at this point, or I don't think I'm where I should be at this point based on how much work and effort and energy and time that I've put in. But you have to look at growing your business, growing your investments. It's all about just like an airline pilot, right? We've flying on planes left and right the last 2 months. And who do I want to get in to the plane with? Do I want the pilot who had 1,000 hours of experience and he's been in for a couple of years, or do I want the guy who's been around for 20 years as a pilot, but he has 50 hours flying experience, right? So it's not so much how long of the time that you've been in since you started, it's how many hours have you actually logged. And if I really look at how many hours I've logged into this business, I'm probably right where I should be based on the time that I've put in. So just stop, look at that, consider that. It's not timing the market, right? It's time in the market. It's the same concept. How long have your dollars actually been invested? You could say, well, I've been in stocks for 20 years, but I've been in and out multiple times. So how long have you actually been in the market, logging hours, logging days, logging years? And that's what's going to give you the incredible returns that you're after, not, sporadically coming in inconsistently. All right. So anyways, that's not what my topic is about. I just wanted to throw that in. My topic actually today is about cash management, because I had a situation just kind of come up that kind of led me to say, oh man, this is a great topic, because this is something that I personally struggle with. And I don't think I necessarily have it figured out, but I have a good system down. And even with a good system, guys, there's still struggles that I'm going to talk to you guys about. So what happened is that I need to come up with $52,000 in cash to pay the remainder balance on the Bitcoin mining container that we just got completed, or is being completed this week, to get our mining operation, all of our machines plugged in and generating the Bitcoin income. And so the final amount due is $32,000 higher than what I was originally told the final balance would be 8 months ago when we put the down payment on to start it and ordered it. Due to, of course, supply chain issues. I don't know. Sometimes I wonder if people are making this shit up, but for the parts that we needed, they all came in substantially higher. So I was trying to figure out how I'm going to come up with this extra cash that I was not planning on. In what way am I going to fund this? Because, obviously I need to pay this balance due, because if I don't, well, what's the alternative? That we could either, if he really wants to be a dick, he could just say, well, you didn't complete the contract, on time. And so, you're forfeiting this container. He's cool. So he's not going to do that. So we definitely got to come up with the cash and get this squared away. So how do I go about doing that? So I'm going to tell you guys about my cash management system and what I've done in this. I think this will be very, very good for you guys, because the big question, I get asked this all the time: how much cash should I have on hand? Well, just like everything in finance, the answer is it depends. And it depends on a lot of factors, which, we'll talk about. So taking you guys back to the scenario when I first got started in investing, and the first major setback I kind of had with cash management is when my stocks dropped like a rock, and the bubble crash of 2000. You guys have heard this story before, I know. I mean, it was obvious to me at that point in time, I had made some mistakes, right? The obvious ones I've talked about: chasing past returns, hyper focusing all my investable cash into a risky speculative asset. But the not so obvious mistake, and as it turns out, the far bigger one, was a lack of cash management. Now, there will be plenty of times over your wealth building career that you'll buy into an asset and then watch that asset absolutely plummet. Okay. Hate to tell you this, but I think you guys know that this is true. Some of you have experienced it already. It's just part of building wealth. And I'm sorry to break it to you, but it'd be just like saying you can golf an entire round, or even worse, you can golf your whole life and you're not ever going to end up in the bunker behind a tree like I did last night, or in the bottom of a pond, lake, river, creek, stream, or whatever body of water where you got to absolutely have no shot out. You are going to get a first glimpse of what hazards really are. And one of those hazards is running out of cash and then having to sell your assets in a down market. And that was the huge mistake that I made, is that I invested too much, was not thinking about future cash drag. Cash drag is, how many months that you can go living off the cash that you have before you run out. So I don't like to have cash sitting in the bank. You guys are clear on that. Not only is the purchasing power eroded by inflation, but there's plenty of lost opportunity cost, which is essentially what I'm giving up by taking a certain course of action. That's opportunity cost, right? So in the case of uninvested cash, when you see tech stocks cranking up 40% a year back in, 97, 98, 99, that led up to me wanting to put my money to work, looking at it in the bank, making, 1% interest or less, your opportunity cost looks a lot like 40%. But what I failed to recognize that in a few short months, my life was about to change more drastically than at any previous point of my life. And beyond having kids, that was the biggest kind of change or transformation that I went through more than any other point over the next 2.5 decades of my life up until this point, age 44. I was moving from college student with little to no personal financial responsibility into the real world where I'd be responsible for all of my own expenses. I'd be making my own house payment, buying a new car, insurance, food. Shit, I'd have to buy a fucking ironing board unless I asked for that for Christmas, which I did, which was maybe one of the most depressing years of my life, that moment. When I woke up Christmas morning and wrapped was an ironing board and not a Nintendo or some type of GI Joe configuration, right? I was like, what? This is what real life is like. Ironing boards, this is awful. So the days of being able to bank almost all of my cash were soon to be over, and I had not factored in that transition at all. So when the stocks did crash and my business dropped, and now I had monthly bills, I was in a budget deficit and I just couldn't go on and turn on the printing press like our government to solve my problems. I had to sell assets that I owned, and the ones I owned were stocks, the stocks that had dropped 50% in order to raise cash to live. Otherwise, I could potentially be moving back in with my parents, which, as much as I love them, I could never let that happen. That would be the mother of all crashes, right? So I'm aware that there are certain things that when I do them on a daily basis, my life is much better. One of those is reading scripture and getting my mind right to start my day. Now, admittedly, I'm consistently inconsistent and I struggle with staying focused. If you put a Bible in my hands, I mean, I really honestly will probably fall asleep. I'm sorry, I hate to say that, but it's pretty much how it goes. It just really have a hard time understanding what they're trying to say, because there's always whatever they're saying is not really what they're saying. There's hidden meanings and analogies and stories, and you don't understand the times that they were living in to have context, right? So the best way for me to soak up the wisdom is to read books that have little pieces of scripture and then modern day teaching principles all wrapped together. One of the books I'm reading, and typically I only do this for about 10 to 15 minutes when I wake up. One of the books is called And Then God Created Golf. It's a short book to guide the Christian golfer not only through the mind-numbing challenges of an insanely frustrating and very difficult game, but through the tough seasons of life. And here's a quote I read this morning. You are a fortunate person indeed if you can begin each day accepting the fact that during the day, there will be ups and downs, good breaks and bad ones, disappointments, surprises, and unexpected turn of events. At the same time, wise golfers have learned to accept those adverse conditions on the golf course as representative of real life challenges. So just change a couple words around, and we have the perfect summation of the summary of investing life, of managing your cash flow. At the same time, wise investors have learned to accept those adverse conditions in their portfolios as representative of real life challenges.
Hey, thanks for supporting our show. If you want to find great rental properties that are not available to the general public, subscribe to our Insiders Club email list. Just head on over to highreturnrealestate.com and wait for the pop-up.
You know, there are many fundamental traits that go into being a wise investor. There's a host of traits that we can look at and consider when analyzing whether an investor is wise or foolish. Professional development, which is consistently focusing on your learning and on increasing skills to increase income. Proper asset allocation and not having all your eggs in one basket. Patience, buying things you understand, holding great assets for long periods of time. These are all extremely important characteristics of wise investors. But at the top of this list, in my humble opinion, cash management. Several years back, I remember reading a Sports Illustrated article of the widespread financial issues that professional athletes deal with after retirement. I couldn't believe the numbers. Now, I just did a quick Google search to verify. I don't believe everything I read, and this may or may not be accurate, but I believe, based on other articles that I've read on this subject, it's probably not too far off. It says 78% of professional, highly paid athletes go broke after just 3 years of retirement. Wow. Now, clearly, going from not making much money to all of a sudden getting paid millions, and not all athletes, professional athletes, get $1 million contracts. In fact, while I was in Cabo, I've been getting to know another really successful guy, Tyler, in our direct sales company. And he was a former professional major league player. So I'm like, we're on a shuttle together for a solid, half hour when we got off the plane, and riding from the airport in Cabo over to the resort, the Hilton in Cabo. And so I'm picking his brain the entire time. I want to know, what was the major league experience like? How much money did you make? Like, what were the pitfalls? What was the difficulties, right? I mean, what we read about is obviously a lot of times very different from somebody's inner perspective. He made, pretty good money. He would make $500K a year. I think maybe one year he made $1 million. And then after about 5 years, he's out of the game. And he just said there wasn't a market anymore for his services because he just gets replaced by younger players. So clearly, not all professional athletes make millions and millions of dollars. And so going from 500,000, though, to, potentially as a major league player, to then going, and getting a job or working a business, you're going to have several year period where you're going to have to, probably bank and work your way back up to that type of earning power. And some never will. Some never will get back to that previous earning power, and some will never get close. It's also, look at this, lottery winners, they aren't in any better shape, right? And whether they win 500 or 1 million or multiple millions, about 70% of lotto winners, and I think this number is low, they lose or spend all that money in 5 years or less. I think if you looked at over the course of a decade or 2 decades, I would say it's probably closer to 99% are broke. Projecting future cash needs is not only difficult for the young college age version of Jack, but for everyone else too. Now, standard financial mainstream advice, and I've given this advice out. This is not terrible advice by any stretch. It says to have 6 months worth of living expenses socked away in cash as your emergency fund. And I fully support this advice. In fact, I just did an Instagram reel where I said the only situations where you should not be investing is, and this has nothing to do with the markets or state of the markets, and that's what people think when they probably first read the headline. But the reason they should not be investing is if you're paying off high interest debt, or if you're funding your emergency fund. And in those cases, I don't think you should be investing. I think you should be focused on those two things, because those two things are fundamentals. You're building your house on rock instead of sand. So here's the question though, is 6 months enough or is it too much? If you have 3 months of emergency expenses, is that enough? And then the other 3 months that you would have banked in cash, you could be investing and getting a return off of. Now, here's the big thing. There's different forms of cash. After all, we want to maximize our return on invested cash and minimize the damage that inflation does to cash sitting on the sidelines. So what's the best answer? And like I said, a lot of it depends. So let's unpack what it looks like to have the right mix of cash management. Now, the question that most people ask is, how much cash should I have on hand? I believe the more important question to ask is, how much liquidity should I have? Having cash on hand in an emergency fund is typically either one of two things or maybe both. It's either actual cash in a safe or under a mattress, which I don't recommend, put it in a safe, right? Or cash in a bank account. So what I'd like you to start thinking in terms of liquidity. Liquidity is simple. It indicates a person or a business company's ability to pay their debt obligations or their current liabilities without having to raise external capital or to take out loans. High liquidity means a person can easily meet their short-term expenses and debts, while low liquidity implies the opposite, and that a person or company could imminently face zero cash situation and possibly even bankruptcy. So I want to give you guys 4 ways to consider boosting your liquidity so you can confidently navigate the hazards of modern American financial life. And we know this, you are going to have lots and lots of hazards thrown at you in your financial life, and you want to be prepared when they're thrown your way. So here's number 1, cash, as in cold, hard, physical cash you can touch. Cash in my safe gives me that warm, fuzzy feeling of knowing at a moment's notice I can easily access cash. I don't like to keep a lot of cash on hand, but typically a month worth of expenses is pretty sufficient in my view. The reason why we want to have cash is because if we really hits the fan, we want to be able to get something quickly. I can get to my cash very, very fast within a couple minutes, right? Because each layer that I'm going to give you here, guys, as we step up, your cash isn't quite as accessible. It'll take you a little bit longer to be able to access it. So number 2, cash in the bank. I keep enough in my checking accounts for about 2 months, maybe 3 months of expenses. Since bank accounts pay out a measly, 0.01% interest, I think since the Fed's been raising rates, I bet you it's gone up to like 0.02, 0.03%. I'm sure they've really been generous in their payouts they're giving us on our cash and our checking accounts, right? Yeah, probably not. Since they only pay this measly 0.01% interest, and then they take my hard-earned cash and loan it out for many multiples of what they pay me. So they're making huge spreads, huge amounts of money on my cash in their bank. They're the clear winners and I'm the clear loser in this arrangement. So I prefer to give them the least possible amount. I want to be the shittiest high net worth or whatever, even low net worth customer the bank can possibly have. And by giving them the least amount of my cash sitting there, that's how I become a shitty customer for them. That's in your advantage to be the worst customer for a bank you possibly can. You do not want a bank monetizing you because that means if they're monetizing you, you're not monetizing yourself. All right. So number 3, a HELOC. Now, this is where one might get a little surprised that I'm putting this in this cash management type of outline here. What is a HELOC? It's a home equity line of credit. Now, most people treat their home equity like an ATM machine. When they really want to buy something or they really need to buy something, they borrow out their equity. After all, it's their money, right? And they tap it for their next luxury vacation or the, extravagant kitchen remodel they've always wanted to do. And prior to the 2008 housing crash, Americans were maxing out their home equity to the point where they had no margin for error should housing prices actually drop. We know how this story ends, with millions of people underwater, meaning you're underwater because you owe more on the home than the home is worth. and then having to come to the closing table if you need to sell your property with cash to release the mortgage, or worse yet, millions of people got foreclosed and lost their home and their credit and their pride. The way I use a HELOC, and I suggest you do, is more of a cash management tool. I open up the HELOC when I don't need it. That's the key. Number one, open the HELOC when you don't need it. So when I do need the cash, which I'm never going to use it for a liability, I'll only use it for assets or like real serious emergencies. Then I don't have to go through the month-long process of applying for loans, the appraisals, financial documents, signing over the rights to my firstborn son, and etc. I can drive to the bank and have a check in my hand that day. What I love about these types of loans is that unless I use it, I don't pay any interest. And if I use it and, say, take out the loan and draw against the home equity line of credit, well, I can pay it back when I have a cash infusion if I choose, and I can get rid of that interest payment, right? So how much do you have, or do I have, in emergency expenses in my HELOC?
Hey, thanks for being a listener. To find great rental properties and become a more savvy investor, head on over to highreturnrealestate.com.
Well, typically it's several months of liquidity. Now, I have tapped out my home equity line of credit when certain assets went on sale. So I pulled out and I used part of that HELOC to be able to buy assets that when they went on sale. And I think this is a great way. It's a great strategy in how to use your HELOC. Now, I still want to leave a portion of my HELOC untapped so that I have that there in case of an actual, like a real emergency where I really need cash, right? So several months are, in addition of liquidity, are in this. Now, where the bulk of my liquidity lies is in number 4, a high cash value whole life insurance policy. Now, to me, and I've said this before about this asset, this is not so much of an investment to me as it is an incredible cash management system. This is, again, where the bulk of my emergency funds reside. Why? Well, because a properly structured whole life policy allows my money to grow at much higher rate, which mine is growing around a 5.5% after tax rate. And that's the great thing about whole life policies, is the money grows tax deferred or tax protected. So a return of 3.5%, which is what I get, it turns into 5.5% after taxes are factored in, because I don't ever have to pay taxes when I borrow money out of these policies or when I tap the liquidity out of my policy. If you guys want more on this subject, go to episode 15, how to make your money make 2 places at the same time. It's a special interview with special guest Rachel Marshall, and she does a great job of explaining all the pros and what it looks like when you have one of these specially designed policies. So this protects my family should something ever happen to me, which would certainly disrupt our household earning power in a big way. And it also protects my cash from a lawsuit. Whole life policies are not allowed by law to be named as an asset in a judgment. Most importantly, though, is the liquidity factor. I can call my broker and within a week have funds wired to my bank account with no loan application, no credit check, and without worrying about being in debt. I simply borrow against the collateral inside my policy, which is my cash value. I never have to pay it back out, because if I don't, when I pass, they'll just subtract the amount that I borrowed back out from my overall death benefit. And it's a non-taxable event when you borrow versus when you sell. So I can borrow always, and that's the only thing I'll ever do. I'm never going to cash out my cash value, so to speak, because then I'd have a taxable event. Consider the difference between, borrowing against your policy versus having to sell your stocks. You're either selling for a loss in a down market, which is about as bad of a financial choice as the predatory fees on credit cards, check cashing businesses, and higher risk, higher interest rate car loans. Or you're selling at a gain, which is then taxed at your ordinary income rate if you're selling with less than a year of ownership. And maybe even worse than that, you're interrupting the compounding growth of those assets. And compounding is the eighth wonder of the world, according to Warren Buffett, just because it's so incredibly powerful over the course of time, how much compounding of your money increases your wealth dramatically. So that's 4 points. Now, I'd love to add a number 5 to the list, but I can't. And you may be able to guess cryptocurrency, but eventually I'll be able to, but it's not ready yet because it's so volatile. At some point in the future, when we have mass adoption, meaning everyone in the world is using crypto throughout their daily lives in some capacity, then and only then will we have the stability in this asset. Once an asset is stable, then it will make sense to be able to consider it a form of liquidity, as a form of emergency cash, as a reserve asset. But with the vast swings in this asset, like the one we just saw with a 67% drawdown, I'd be a pretty terrible wealth strategy coach to tell you it counts as a reserve asset. But that day is coming, and potentially faster than what we may think. So how did I end up paying for the extra $32,000 bill that I got on this Bitcoin mining container? Well, I was about to tap my whole life policy, which I did not want to do. I want to leave a chunk of that open. I've already borrowed quite a bit out of it. I wanted to leave a nice chunk of it available should there be a real, true emergency. So I was about to, but actually have a house, a property that happened to be closing, and closed just in time to where the amount that I needed was perfect. It was just the right amount I needed from the proceeds of the sale, after paying off the loan that was against it and all the taxes and closing fees, commissions and all of that to realtors, all that stuff that they take out of my property sale, which I hate all that middlemen closing rates, guys. And that's why I think crypto is going to absolutely replace all of those middlemen. And that'll happen probably within the next 5 years, creating more money that's left in our pockets as consumers, right? As the one who owns the assets. That's a different subject for a different podcast. So what I did, I had peace of mind. I wasn't stressed. There was no anxiety, which if I hadn't had that backup with the liquidity of the whole life policy, then I would have had to wait for this house to close. And what happens if it got delayed another month? That happens to me all the time. Then I would have had to take other measures, which I didn't want to do, to be able to try to figure out how to get that money raised to be able to pay off the final balance and the final bill, right? So what is the right amount of liquidity to have on hand? Well, now you're asking the right question. And I think it's more than we think. I have a full year of liquidity when you add up all 4 of these forms. Now, if you threw in number 5, crypto, which is kind of to me is like, okay, that's a bonus. It's not anything I'm depending upon, but if I needed it, I could go into my Nexo account. I could borrow 10, 20% of my assets against those. I think that's probably not irresponsible, although that money could get called due if crypto were to really drop again or to crash again. And then they would call that, would be called due, called a margin call, right? That is something that, though, I can consider as an extra form of liquidity, even though I would never put it in or rely upon it or depend upon it by any means. But in addition to these 4 different ways of liquidity, we also have precious metals, which can be converted into cash. We have guns and bullets, which have a lot of value. We have a full year food supply with a shelf life of 25 years, because I want to be prepared for any of the hazards that life throws at me. And I would strongly encourage you to be considering the same philosophy.
Hey, thanks for your support. If this episode was valuable to you, then show us some love. Subscribe and take 1 minute of your time to leave us a review. This is how we get the word out to help more investors. And best of all, it's good for your karma.